If you look at the volume on like silver and stuff like that, it's just dried right up. Nobody's interested in silver anymore. And if the masses are naturally getting more worried and they're selling, it means they're all going to move together. To me, it's a bearish. We should be seeing gold go higher and stocks go down. I don't know what's going on. And the charts of both gold and silver are topping patterns they put in are pretty scary. I mean, that's quite the noise, quite the volatility. It's not a good sign. My view on gold right now is it's not a trade. It's just let it mature, let it build a pattern. And if it collapses and goes into a huge sell-off, it'll become an amazing buying opportunity because long-term, I am extremely bullish on precious metals. And so right now, gold to me, short-term wise, it looks like put in a major top. I don't want to hold it. We could see 3,600 fairly easy in gold. If gold and silver take a year and a half to go sideways, not only are you going to not make any money, it costs you money to store it. Every day you've got the stress of hoping and praying they don't keep collapsing, where you could just step aside in a cash position, which is the most boring position ever.
Gold is no longer a safe haven play. Let's pull up a chart of gold and I'll show you what I'm talking about. Gold has been acting pretty much like a Nasdaq or S&P extension, moving in lockstep with stocks, moving down when there's bad news with Iran, and moving up when the opposite happens, when there's good news, like today, for example, when Trump has announced that there's more negotiations with Iran. So the point is, gold is not doing what a lot of investors would expect it to do for a traditional safe haven asset, which is actually hedge against equity volatility. Its volatility is moving in lockstep with stock market volatility. Can you comment on this?
Yeah. So, I mean, gold has been doing what it should do for the last several years. It's been going up. Tensions have been rising. Things have been looking more bleak. And that's why we've seen both gold and silver moving higher. Now, the typical kind of scenario when it comes to the stock market or investing in general is it's like buy the rumor, sell the news. I think gold has been moving up with anticipation of all kinds of things falling apart. War kicked in. I mean, I think we went into this capitulation top. So gold did what it was supposed to do, but now we've hit this tipping point where I feel like it's put in a significant high, and now it's going to start moving with the stock market.
Gold behaving like a tech stock is the kind of signal markets quietly flash before bigger problems surface. As Chris Vermeulen points out here, gold tracking equities instead of hedging them suggests liquidity, not fear, is driving both markets, which is a major shift from historical behavior. When geopolitical headlines move gold and stocks in the same direction, it tells you institutions are trading narratives, not positioning defensively. That buy the rumor, sell the news cycle likely peaked into a sentiment-driven top, not a structural breakout. Next, Chris Vermeulen discusses why this shift could expose investors expecting protection.
And this is the fear. If the stock market sells off, then we're probably going to see precious metals sell off. And this is what I've talked for a long time is not many things are safe when we go into a financial crisis or a bear market. And so we are seeing, I think a lot of people got rattled on this move. A lot of people who have held through here, they're really starting to panic and feel the pain. And now we're just seeing it move like the stock market because I think the safe haven play is somewhat moved out. There's so much volatility. It doesn't feel that safe anymore. And it looks like it's got a pretty major top in the price action. Now, if we use Fibonacci extension, just based on this initial drop and this bounce to the upside, we can see that gold ended up hitting our target. And I'm not sure if you and I, we talked about this a long time ago. These are inside bars. We have this big red bar, and then all of these days coming all the way up to the top. And I talked about how this is a bearish price pattern. If it gets rejected at the top of this bar, look out below because it's going to sell off and it's going to want to come down to the 618 or this previous low and down to the 100% measured move.
The uncomfortable truth is that in real crises, correlations go to 1 and nothing stays safe. As Chris Vermeulen points out here, gold selling off alongside equities isn't abnormal in liquidity-driven downturns, but many investors still expect 2008-style protection without recognizing today's leverage and positioning. The Fibonacci targets being hit alongside a bearish inside bar structure suggests this wasn't random volatility. It was a technically exhausted move. When retail panic begins after a topping pattern, it usually means smart money has already exited. Next, Chris Vermeulen talks about how this setup could evolve into a deeper unwind.
And that's what it's done. And so right now, gold to me is in this, to me, short-term wise, it looks like it has put in a major top. I don't want to hold it. We got out way up here before that drop. But now it could potentially build a giant bull flag here. And who knows, maybe it takes a year. And then, of course, if it starts to break out and it shows signs, then you definitely want to get long and catch that next move up. But what we don't want to do is hold on to something that clearly shows it has run out of steam, that is not the play that everybody, that it used to be. It's not that safe haven play right now. And it could actually unwind and come on down a whole lot lower. We could see 3,600 fairly easy in gold, I believe. So right now we are in this pause mode. And I mean, I was with you in at VREC in Vancouver when these prices were spiking. And I mean, I was on the panel saying, like, listen, I think we're going to see at least a 30 to 40% pullback in silver. I think we're going to see a big 20+% pullback in gold. All the signs are there.
What looks like consolidation to most investors may actually be the early stages of capital rotation. As Chris Vermeulen points out here, stepping aside after a parabolic move isn't bearish long term. It's a recognition that momentum has already peaked and risk-reward has flipped. A potential 20% gold pullback and 30 to 40% in silver isn't extreme when you consider prior cycles like 2011, where similar sentiment peaks led to multi-year resets. The idea of a bull flag forming over a year highlights time risk, something most portfolios underestimate. Next, Chris Vermeulen discusses why waiting may outperform staying invested.
I was talking to people on the floor that had never bought metals before, and they had just bought silver at like 110 and all this stuff, or 106 or 108. And so when all these signs are there, you got to be cautious. And then prices now confirm that. So my view on gold right now is it's not a trade. It's just let it mature, let it build a pattern. And if it collapses and goes into a huge sell-off, it'll become an amazing buying opportunity, because long-term, I am extremely bullish on precious metals. All the fundamental data, all the economic data, everything going on, the central banks is the most bullish sign ever, but it doesn't mean price is going to just keep going up. It will have these corrections. So we just need to let gold figure itself out. And you're right, when we have broad market selling, it will move with the price of the stock market. And that's why a bear market is broad market selling. It's everybody's scared, everybody's selling everything. And that's the phase that gold and silver are in right now. So I think if you're a long-term gold investor, you either have to ride out more of a roller coaster, or you just got to give it time and it will recover, but it might still take a long time.
When first-time buyers rush in at peak prices, markets are usually closer to a top than a breakout. As Chris Vermeulen points out here, retail piling into silver above 100 reflects late cycle euphoria, not early stage opportunity, especially when fundamentals were already priced in. The key contradiction is clear. Long-term bullish macro doesn't protect you from short-term drawdowns, particularly in broad sell-offs, where everything gets liquidated. Central bank demand may support the long-term trend, but timing still dictates returns. Next, Chris Vermeulen unravels why patience, not conviction, is the real edge here.
The price pattern that we have is actually very similar, especially in silver, to what we saw in 2011, where everybody, thought metals were going to the moon, and then it took 10 years to come back. It sold off. I'm not saying that's going to happen, but you definitely don't want to waste 2, 3, 5 years waiting for metal to come back when you could move somewhere else and not have to watch your account go down. You could potentially buy it at a lower price or buy it later as it's starting to go higher, so that you can just catch the upswing and not have to ride the wasted time in the roller coaster.
Let me just show my screen.
Sure.
Real quick. If you have something like this is gold and copper moving in lockstep together. These two assets have not historically moved so closely together as we are seeing right now. By right now, I mean over the last year, and especially over the last couple of months. I know this is a broad market sell-off, but when metals start moving together, does that signal something bigger in the economy where perhaps markets are large?
History doesn't repeat perfectly, but when price action rhymes this closely with 2011, it demands attention. As Chris Vermeulen points out here, the real risk isn't just a drop. It's time decay. where capital sits idle for years while other sectors outperform. Gold and copper moving together breaks a key macro signal, since copper typically reflects growth while gold reflects fear, and that convergence suggests liquidity distortion, not clarity. When asset classes lose their distinct roles, it often precedes broader economic confusion or transition. Next, Chris Vermeulen discusses whether this alignment signals something deeper beneath the surface.
I'm not sure. I don't follow copper too closely. I think when things start moving together, it more so just means everything is part of the same tide.
I see.
If the masses are naturally getting more worried and they're selling, it means they're all going to move together. To me, it's a bearish line. We should be seeing gold go higher and stocks go down, but I think we're maybe already past that point. And now actually people are just like, I don't know what's going on. And the charts of both gold and silver are, those topping patterns they put in are pretty scary. I mean, that's quite the noise, quite the volatility. It's not a good sign. And so I think people have just turned the page. I think a lot of people have gone from precious metals are the play to now they're like, I'm kind of scared to get in. And, if you look at the volume on like silver and stuff like that, it's just dried right up. Nobody's interested in silver anymore.
When everything starts moving together, it's usually not strength. It's stress spreading across the system. As Chris Vermeulen points out here, the breakdown of traditional correlations signals a market driven more by collective emotion than rational positioning. Gold failing to rise while stocks weaken flips a core defensive narrative, suggesting we may already be in a late-stage distribution phase. The drop in silver volume is especially telling. When interest disappears after volatility spikes, it often marks investor fatigue, not stability. Next, Chris Vermeulen unravels what this loss of participation could mean for future price action.
And if you try and sell your silver at like a pawn shop or something like that, they don't want it. Every pawn shop is full of silver. I don't know exactly what that means, but it definitely means people just don't want silver at this point. And the volatility's got people shaken up.
So even if somebody hasn't gotten into gold and silver right now, he should probably stay out. Is that what we're talking about?
I believe. I mean, it doesn't matter. Like so many people always think you got to buy low. You can buy high and you can buy higher. So, if the market rallies from here and then it starts to break out to new highs, you can just jump in and buy it. Even at an all-time high, it's still going to have a massive potential rally. The next big leg from this potential bull flag pattern that gold is forming is huge. So who cares if you pay a higher price? But what I try to avoid is I try to protect our portfolios so they don't go down in value substantially. And so that we also don't waste years.
When even pawn shops are saturated with silver, you're seeing the physical side of a sentiment collapse. As Chris Vermeulen points out here, this isn't just price volatility, it's a demand vacuum, where retail enthusiasm has flipped into disinterest almost overnight. That shift matters because markets don't bottom when people are confused. They bottom when fear peaks and forced selling exhausts. The idea of buying higher instead of catching falling knives challenges the emotional instinct most investors follow, but it aligns better with trend confirmation. Next, Chris Vermeulen talks about how protecting time and capital changes strategy.
Like if gold and silver take a year and a half to go sideways, not only are you going to not make any money, it costs you money to store it. Every day you've got the stress of hoping and praying they don't keep collapsing, where you could just step aside in a cash position, which is the most boring position ever, but you could still make your 4% every year and dramatically outperform holding metals, and then just jump into metals when they start the next rally. I like to be involved with something that is on the run. I don't want to hold something chopping around that shows signs of weakness, which is what the precious metal space is showing right now.
What about stuff like this? Let me show you the CNN Fear and Greed Index, which is currently at extreme fear. I was surprised when I pulled this up just now. I thought it would be maybe leaning more towards neutral, especially on a day like today when the markets are rebounding. But extreme fear is what they have. It's an amalgamation of a few technical indicators. Are you seeing extreme fear flashing on your dashboard based on the trackers that you follow, Chris?
Holding a safe asset that drains capital and adds stress is a risk most investors underestimate. As Chris Vermeulen points out here, sideways markets create a hidden cost, lost opportunity, storage expense, and emotional fatigue, all while safer yields like 4% cash quietly outperform. The disconnect between extreme fear readings and market rebounds suggests sentiment indicators may be lagging or misaligned with real positioning. If fear isn't translating into capitulation, then the market may still have unfinished downside. Next, Chris Vermeulen discusses whether this fear signal is real or just noise masking underlying weakness.
No, we're actually not seeing extreme fear. Yeah, that greed index that will kind of gauge probably a different group of people, but based on how I follow with my sentiment tools and indicators, we're not seeing actually real big panic selling just yet. There's no doubt the market looks oversold, but I think the market is ready for a bounce, but we're not seeing full on panic selling at this point. We haven't seen it in a little while. And I think the stock market could have maybe another leg down, another big red bar or two to the downside. And I think that will be just enough to trigger some panic selling. I mean, I follow very short-term levels. That fear index is probably looking more so at swing traders and investors. I look at more or less intraday spike levels because that's actually what to me gives me the most imminent, okay, this looks like a pivot low today type of thing. But we're not seeing, I don't think, panic fear just yet.
Markets rarely bottom when everyone thinks they already look oversold. That's usually just a setup for the next drop. As Chris Vermeulen points out here, the absence of true panic selling suggests this isn't capitulation, it's hesitation, which often precedes another leg down rather than a sustained recovery. Sentiment indicators diverging from price action highlight a key issue. Retail may feel fear, but institutions haven't been forced to liquidate yet. Historically, major lows form only after aggressive selling spikes, not quiet pullbacks. Next, Chris Vermeulen talks about what kind of trigger could finally push markets into real panic.
When something does move into the extreme level one way or another, fear or greed, is that usually a contrarian indicator for you?
Yeah. So for example, if the trend is down and then we see FOMO buying on the charts, meaning people are piling in, they're buying stocks, that usually is an indicator that the stock market is going to probably sell off. So if the trend is down and we have these waves of FOMO, so let me just share my chart. I'll kind of give you a visual here of what that looks like. So here we've got and I like to look at the 30-minute chart for this, which is the left-hand chart. So this is the 30-minute chart of the Nasdaq. When the bars are red, that's telling us the short-term trend is down. Easy way to do that is price under the 20-day moving average. Is the 20-day moving average sloping down? That is the most basic way to get an idea of a swing trading trend. But I have this red indicator here, and this is FOMO buying. When people jump in and they buy stocks, and we see this FOMO indicator jump over this blue line, which is a ratio of 3, which is 3 buyers, 3 people hitting the ask to every 1 person buying on the bids.
The most dangerous rallies are the ones fueled by desperation, not conviction. As Chris Vermeulen points out here, FOMO spikes during a downtrend are often signals of exhaustion, where late buyers chase rebounds just before the next leg lower. This 3-to-1 buyer imbalance shows urgency, not strength. Investors paying any price simply to avoid missing out, which historically marks short-term tops rather than sustainable recoveries. When price sits below the 20-day moving average, momentum remains structurally weak despite these bursts. Next, Chris Vermeulen discusses how these emotional surges create predictable short-term reversals.
So 3 times more people just willing to buy. They don't care what price they pay. They're just saying, get me in, I'm missing out. The market has this huge bounce up, I'm getting left behind. And so when we get this spike level of FOMO, it usually is a significant indicator that the market is going to pull down short term, only for a day or two. We had it again over here, it hit our threshold. Market gapped up, everybody piled in, they felt like the market was putting in a bottom, and then it sold off. And so this is the type of a fear indicator that I use. This is a very short term. This is fear of missing out. We also have when the market is like in an uptrend. If we were to kind of go back, let's go back to an uptrend here. If we go back to an uptrend, we'll have the opposite. We'll see these spikes of panic selling, which is the fear index you're looking at. This is more of that type of fear of losing money. And then we tend to see the market put in a very significant low, usually after a big spike of panic. It usually bottoms out the next day. So we have this, and then the market wants to rally. And then we have another wave of panic. And you get the panic, it carries over to the next day, and then you get that rally. So these are the short-term fear index that I look at. Fear of losing, fear of missing out, and the market just ping-pongs around through all of this. So I don't remember what your question was exactly, but these are the types of fear I'm looking at. And if we were to just fast forward to today, we don't have any fear at this point yet.
What feels like momentum is often just emotion cycling between fear and greed at high speed. As Chris Vermeulen points out here, these short-term spikes in FOMO and panic aren't random. They form a pattern where emotional extremes consistently mark reversals, not continuations. The key insight is timing. Panic selling tends to create bottoms, while FOMO buying often signals near-term tops, yet most investors react in the opposite way. The absence of true fear right now suggests the market hasn't fully reset sentiment.